everyone, thanks for joining us. Today we're going to talk about earnouts and contingency payments in the context of a business transaction or an acquisition. Often earnouts and contingency payments are used to manage risk associated with a purchaser buying a business. And to give you an understanding of how they work, I'd like to just run through a simple example. Recently, over the last 12 months, we sold a wholesale food distribution business. And that business had a business maintainable earnings, future earnings of about $1 million. So it was a substantial small business owned by a family. In the market, it was valued at roughly a multiple of 3 times business maintainable earnings. So the implied purchase price was $3 million. Okay. Now, the purchaser did a due diligence on the business and their advisor identified a number of risks, but one of those was a key risk relating to clients and key person relationships with those clients. The owner of this business had sole relationships with 90% of the business's 50 regular clients. And also, as important, 3 of those key clients represented roughly 50% or more revenue on an annual basis. So the purchaser identified that as a key risk, and they were concerned that should they buy the business, will those relationships transfer with the business? And will the business maintainable earnings hold true moving forward? Because if you're buying a business, you're not buying past earnings, you're buying future earnings. And they were worried that these relationships might disenfranchise with a new owner and therefore not flow through in terms of business maintainable earnings. So anyhow, in the deal negotiations, the purchaser came forward and said, look, we're prepared to pay your 3 times multiple of earnings, so we'll pay you a purchase price of $3 million. However, because of this key risk, we want to structure the deal a little differently. We're happy to pay 60% of the purchase price, or $1.8 million, at close, up front. But we want to keep 40% as a contingent payment, $1.2 million, for the earnout. And how that works is the remaining 40% is not paid, and on this basis, the first 12 months had some targets to ensure that the business maintainable earnings of $1 million were achieved. And if they were achieved, that meant that the client relationships transferred appropriately. Okay? At the end of the 12 months, the 1.2 was paid. Should the business maintainable earnings have been lower at the end of 12 months, the earnout amount would have reduced given the targets negotiated. So you can see how that simple structure allows for a fairness and equity around the risks associated with the deal. Now, there are pros and cons for the purchaser and of course the vendor, because the vendor in selling this business has a lingering risk because they don't get all their money at close. And so it's important, if you're a vendor and you're tackling whether to sell the business with an earnout or a contingency payment, to make sure you have a good advisor that can structure a deal that's fair and reasonable on both sides. We hope you've enjoyed this segment on contingency and earnout payments. If you have, please subscribe to our channel and like or comment, including sending us any comments about future topics that might be of interest to you. Have a great day.